Listen very carefully because what I'm about to tell you could mean the difference between a comfortable retirement and watching your life savings evaporate during the next market crash. If you're over 45 and still think your retirement plan can survive a 40% market decline, you're living in a fantasy world. The harsh reality is that most people approaching retirement are one major correction away from having to work until they drop dead. I don't care about your feelings. I care about your money. And right now, if you're relying on hope instead of strategy, you're setting yourself up for financial disaster. The three exchange-traded funds I'm going to reveal today aren't sexy. They're not going to double your money overnight, but they will do something far more valuable. They will protect you when everyone else is panicking and selling at the bottom. Before we dive deep into this strategy, you need to understand something fundamental about retirement investing that most people get completely wrong. When you're young, you can afford to be aggressive. You can swing for the fences with growth stocks and speculative investments because you have time to recover from losses. But when you're within 20 years of retirement, the game changes completely. You don't have 30 years to wait for the market to come back. You need your money to work now, consistently, without the wild swings that can destroy decades of savings in a matter of months. This is why I'm obsessed with what I call defensive wealth building. Notice I said both defensive and wealth building because you need both. You can't just hide your money under a mattress and expect it to keep up with inflation, but you also can't chase high-risk, high-reward investments that could wipe out your retirement fund just when you need it most. You need a strategy that protects your principal while generating the income you'll need to maintain your lifestyle. The problem with most retirement advice is that it's either too conservative or too aggressive. Financial advisors either tell you to put everything in bonds and earn nothing, or they encourage you to stay in growth stocks and risk everything. Both approaches are wrong. The right approach is strategic diversification using instruments that have proven themselves during multiple market crashes over decades. Let me tell you something about market crashes. They're not rare events. They happen regularly, predictably. And if you're going to be retired for 20 or 30 years, you're going to live through multiple crashes. The question isn't whether another crash is coming. The question is whether you'll be prepared for it or become another casualty. I've seen people who did everything right for decades lose half their retirement savings in 2008 because they weren't properly positioned. I've seen couples who thought they were conservative investors watch their portfolios get destroyed because they didn't understand the difference between being safe and feeling safe. The difference between those who survived and those who got crushed wasn't luck, it was preparation. The three ETFs I'm going to walk you through today represent three pillars of crash-resistant retirement investing. Each one serves a specific purpose. Each one has been tested through multiple economic cycles, and together they create a foundation that can withstand whatever the market throws at you. The first pillar is what I call the Dividend Fortress. This is an ETF that focuses on dividend aristocrats, companies that have increased their dividends every single year for at least 25 consecutive years. Think about what that means. These companies survived the dot-com crash, the financial crisis, the pandemic, multiple recessions, and they still found ways to pay shareholders more money every single year. That's the kind of quality and resilience you want protecting your retirement. This ETF is filled with companies like Johnson & Johnson, Coca-Cola, Procter & Gamble, companies that sell products people need regardless of economic conditions. People don't stop buying toothpaste during recessions. They don't stop needing health care. They don't stop using household products. These are defensive businesses with incredible moats and track records that span generations. Here's why this type of fund is critical for retirement planning. First, the dividend yield typically runs between 2.5 and 3%, providing real cash flow you can count on. Second, those dividends grow over time, helping you keep pace with inflation. Third, and this is crucial, when markets crash, these companies hold up better than almost anything else because they're essential businesses with fortress-like balance sheets. During the 2008 financial crisis, while the overall market fell over 50%, dividend aristocrats fell less and recovered faster. During the pandemic crash of 2020, while growth stocks went on a roller coaster ride, these steady dividend payers provided stability when everything else was chaos. That's exactly what you need when you're living off your investments. But here's where most people make a critical mistake. They think dividend investing means accepting lower returns. That's wrong. Over long periods, dividend-focused strategies have delivered competitive returns with significantly less volatility. You're not sacrificing growth for safety. You're getting both, just in a more sustainable sleep-at-night package. The expense ratio on quality Dividend Aristocrat ETFs is typically very low, often under 0.4%. That means you're keeping more of your returns instead of feeding Wall Street's fee machine. In retirement, every dollar matters and low fees are non-negotiable. The second pillar of crash protection is what I call the stability anchor. This is a short to intermediate term bond ETF that focuses on high-quality government and corporate bonds. I know bonds sound boring. Everyone thinks bonds are for old people. Well, if you're approaching retirement, you need to think like an old person when it comes to a portion of your portfolio. But we're not talking about just any bonds. We're talking specifically about short to intermediate term bonds because they provide the stability you need without the interest rate risk that can crush long-term bond prices. When interest rates move around, and they will, short-term bonds don't get hammered the way 20 or 30-year bonds do. You get income without the volatility. This bond ETF typically holds investment-grade corporate bonds and treasury securities, meaning you're lending money to the most creditworthy borrowers in the world. The default risk is minimal. You're not going to get rich from this position, but that's not the point. The point is to have a portion of your portfolio that zigs when stocks zag. During market crashes, this is your shock absorber. When everyone is panicking and selling stocks, bonds typically rise as investors flee to safety. That means while your equity holdings might be under pressure, your bond allocation is holding steady or even increasing, cushioning the blow to your overall portfolio. This is why every retirement portfolio needs bonds. It's not about being conservative for the sake of being conservative. It's about being smart and protecting yourself from sequence of returns risk. If you retire right before a major crash and you're forced to sell stocks at depressed prices to fund your lifestyle, you can permanently damage your portfolio's ability to last. But if you have bonds providing stability and income, you don't have to touch your stocks during the crash. You can live off the safe part of your portfolio and let the equity portion recover. The yield on quality short-term bond ETFs typically runs 3 to 5% depending on the interest rate environment, and the expense ratios are incredibly low, often under 0.1%. You're getting institutional quality bond management for almost nothing. The third and final pillar is what I call the balanced backbone. This is a conservative allocation ETF that automatically maintains a mix of stocks and bonds, typically around 40% stocks and 60% bonds, though some versions run 50-50 or other conservative ratios. Think of it as a complete retirement solution in a single fund. For people who don't want to constantly monitor their portfolios or worry about rebalancing, this type of fund is perfect. You buy it once and it handles the asset allocation for you. The equity portion provides growth and dividend income, while the bond portion provides stability and safety. It's a complete ecosystem designed specifically for people who need consistent, predictable returns. What I really appreciate about these balanced funds is the automatic rebalancing feature. When stocks run up significantly, the fund automatically sells some equities and buys more bonds to get back to the target allocation. When stocks crash, it does the opposite, buying stocks at cheaper prices using the bond proceeds. This forces you to buy low and sell high systematically, which is exactly what you're supposed to do, but most people can't because emotions get in the way. The returns on these conservative balanced funds aren't going to set the world on fire, but they're steady and predictable. Over time, you can expect 5 to 7% annual returns with much lower volatility than an all-stock portfolio. More importantly, when markets crash, these funds typically fall 10 to 15% instead of 30 to 40%. That difference is the difference between staying calm and sticking to your plan versus panicking and making catastrophic decisions. The expense ratios on quality balanced funds are also very reasonable, typically under 0.25%. You're getting professional asset allocation and automatic rebalancing for basically nothing. Compare that to paying a financial advisor 1% of your assets annually, and you can see why these funds make so much sense for retirement planning. Now here's the strategic framework I recommend for most people approaching retirement, and this is critical because it's not about picking one fund. It's about building a system that can handle anything. You don't put all your retirement money into just one of these ETFs. You use all three together in a way that matches your specific risk tolerance and income needs. If you need significant current income because you're already retired or very close to it, you might weight more heavily toward the Dividend Aristocrat Fund and the Bond Fund. If you're still 10 to 15 years from retirement and can handle some volatility for better long-term growth, you might allocate more to the balanced fund. The key is building a portfolio that lets you sleep soundly at night, regardless of what's happening in the markets. Think about it this way. If you have $1 million saved for retirement, you might allocate $300,000 to the Dividend Aristocrat ETF, $300,000 to the short-term bond ETF, and $400,000 to the balanced fund. That gives you diversification across strategies and asset classes. You have income from dividends, stability from bonds, and growth potential from the balanced allocation. When one component is struggling, the others are likely holding up or even advancing. This is the beauty of this three-pillar approach. You're not betting everything on one strategy or one asset class. You've built a fortress around your money. When the storms come, and they absolutely will come, you're going to be fine while everyone else is running around in panic mode. Let me tell you what happens when you don't have this protection in place, because I've witnessed this tragedy play out countless times. The market is humming along nicely. Everything is going up. People are feeling confident, maybe even overconfident. They think they're investment geniuses because their portfolios gained 20% last year. Then suddenly, without warning, a crash hits. Maybe it's a financial crisis, a pandemic, a geopolitical event, or something nobody saw coming. Their portfolios, loaded with aggressive growth stocks and speculative investments, drop 40, 50, even 60%. But here's the real killer. Because they need that money to live on, they're forced to sell at the absolute worst possible time just to pay their bills. That's the death spiral. Once you start selling during a crash, you're locking in losses you can never recover from. When the market eventually recovers, which it always does historically, these people don't participate in that recovery because they already sold out at the bottom. They're sitting in cash, watching everyone else make money while they're trying to figure out how to make their remaining savings last another 20 years. It's a financial nightmare that's completely preventable. This is exactly why the 3 ETFs I've outlined are so crucial. They're specifically designed to prevent that nightmare scenario. The Dividend Aristocrat Fund keeps paying you income even when stock prices are falling. The bond fund provides stability and often appreciates when stocks crash. The balanced fund automatically takes advantage of market volatility without requiring you to make any decisions. Together, they create a retirement system that can weather any storm. But you have to understand that market crashes aren't anomalies. They're regular features of investing. If you're going to be retired for 20 or 30 years, you're going to experience multiple significant market declines. The question isn't whether they'll happen. The question is whether you'll be prepared. I want to address the psychology of retirement investing because this is where most people fail. It's not because they chose bad investments. It's because they couldn't handle the emotional roller coaster. When you're working and contributing to your retirement account monthly, a market crash is actually beneficial because you're buying more shares at lower prices. But when you're retired and withdrawing money, crashes feel terrifying because you're watching your nest egg shrink while you're still spending from it. This psychological shift is brutal, and it's why so many retirees make devastating decisions during market stress. They see their account balances dropping and they panic. They sell everything and go to cash, locking in massive losses at exactly the wrong time. The three-pillar strategy I've outlined helps prevent this psychological mistake by providing multiple sources of stability and income. When you have bonds paying you steady income and dividend stocks sending you quarterly checks, you don't feel the same pressure to sell during market declines. You can live off the stable portions of your portfolio and let the growth components recover. This isn't just about the math of returns. It's about the psychology of staying disciplined when everyone around you is losing their minds. Here's something else most people don't consider. Inflation is a silent killer of retirement wealth. If you're too conservative and keep all your money in cash or low-yielding bonds, inflation will steadily erode your purchasing power over time. What costs $100 today will cost $130 in 10 years with just 3% inflation. This is why you need some growth in your retirement portfolio. The Dividend Aristocrat ETF provides inflation protection because quality companies can raise their prices and maintain their profit margins during inflationary periods. Many of these companies actually benefit from moderate inflation because they can increase their prices faster than their costs rise. The balanced fund provides growth exposure that historically has outpaced inflation over long periods. This is the balancing act of retirement investing. You need safety, but you also need growth. You need stability, but you also need to stay ahead of inflation. The three-pillar approach gives you all of these elements without forcing you to make complex timing decisions or constantly adjust your strategy. Let me be very clear about implementation because strategy without execution is worthless. These aren't recommendations to buy specific funds tomorrow. This is an educational framework for thinking about retirement protection. You need to research specific ETFs that fit these criteria, understand their holdings, fees, and track records. You need to consider your own situation, risk tolerance, and timeline. But the principles remain constant. Dividend-paying quality companies for income and stability. High-grade bonds for deflation protection and portfolio stability. Balanced funds for simplicity and automatic rebalancing. These are proven strategies that have worked through multiple market cycles. The biggest mistake you can make is waiting for perfect conditions to implement a defensive strategy. There's never a perfect time to buy insurance, but you definitely want to have it before you need it. Market crashes don't send warning letters. They happen suddenly without permission, and they punish the unprepared severely. If you're within 20 years of retirement and you don't have a crash protection strategy in place, you're essentially gambling with your future. You're betting that the next 2 decades will be smooth sailing with no major market disruptions. That's not a bet any rational person should make. The three-pillar ETF strategy I've outlined today isn't glamorous. It's not going to make you rich overnight. It's not going to generate exciting stories to share at dinner parties, but it will do something far more valuable. It will protect your retirement when it matters most. It will provide steady income when you need it, and it will let you sleep peacefully, knowing that your financial future is secure. Remember, in retirement investing, it's not about hitting home runs. It's about not striking out. It's about staying in the game long enough to win. And with the right strategy in place, you can stay in the game no matter what the market throws at you. That's not just financial planning, that's financial survival. The choice is yours. You can continue hoping that everything will work out fine, or you can build a fortress around your retirement savings. You can keep chasing the latest hot investment trend, or you can focus on time-tested strategies that actually protect wealth. The market doesn't care about your hopes and dreams. It only respects preparation and discipline. Build your three-pillar defense system before you need it. Your future self will thank you when everyone else is wondering what went wrong.